Industrialization also played an important role in China's first stock market bubble. Although the stock exchange in China first opened in 1890 in Shanghai, we do know that there's evidence of over-the-counter trading taking place in securities as early as 1866. By 1930, however, Shanghai was by far the premier venue for raising equity in Asia and was widely regarded as the London of Asia in terms of being able to harness capital for capital formation. Now, the challenge for China's market came with the beginning of the rubber boom in 1909. Because the Model T had first arrived on the market as a mass market vehicle and needed rubber for tires, and Brazil had decided just the following year to restrict its exports of rubber to the world markets, we saw global prices skyrocket. What had the equilibrium price being closer to 40, maybe 50 cents a pound was suddenly $3 a pound in 1910. It didn't take very long for firms around the world, wherever they were, who could access the proper biomes for growing rubber trees to quickly spring into action. In particular, Chinese firms hurriedly established plantations in Malaysia, despite the kinds of business risks that they faced. On top of it all, it's important to recognize that it takes roughly half a decade to grow a rubber tree and to produce any kind of output with which these firms might have actually paid dividends. Unfortunately, though, things seem to have unwound before any of the rubber that was planted could actually be developed. Nonetheless, in order for this to turn into a true proper bubble, there are a couple of other things that are required. In particular, broad public participation in an emerging industry where people don't properly understand the rewards or the risks that are involved. Once you tack on top of this firms exaggerating the acreage they control, and you see an increase in margin lending to investors, coupled with assurances by government individuals who are participating in the frenzy as well, it seemed obvious to the public what to do. And they, of course, followed by pouring money into the large rubber plantations, which were being freshly developed. Unfortunately, as we're going to see, the Chinese government invested not slush funds, but money that was meant to have been invested in railroads and other infrastructure developments on the hope of capturing a quick gain that it would be able to use to try to leap ahead or catch up in terms of industrialization. Unfortunately, like many other bubbles before it, the bubble burst rather spectacularly. In 1911, what started to happen is that companies began to simply recycle rubber. By 1910, with the skyrocketing prices, companies worked on developing new technology, which ultimately undermined the open market price that had risen again as high as $3 a pound, such that by 1911, rubber prices had fallen back down to 50 cents a pound. This all obviously took along the rubber companies, but it also took down, with the collapse in stock price of rubber companies, all of the banks that had lent on margin to various investors. In fact, more than half of Shanghai's native banks failed in just 1910 alone. 20 more failed just 2 years later. This collapse in the value of rubber stocks also drained the coffers of the Qing Empire, who had invested a great deal of money into these rubber stocks, hoping once again for a quick turn of fate. It unfortunately turned the wrong way against them, and with a strained budget, they actually moved to seize other railroads, which ultimately led to the railroad rights of protection movement among the public, which in turn snowballs into the Xinhai Revolution by the following year, which ultimately takes down the Qing dynasty. And this shows you just how dangerous it can be to have stock market bubbles. They can be deeply unstabilizing to societies that may already be struggling to make changes.